Tesla stock had a rough day today, to say the very least. In this video, we will be going over what's happening in our markets today, what the quote-unquote experts are saying, and some pretty exciting Tesla stock news. It appears as if these so-called experts are buying the dip in Tesla stock. I firmly believe any substantial dip that we get in Tesla, which at this point, you've already seen a substantial dip, is a buying opportunity. Let me know what you think down below in the comment section. Tom Lee with Fundstrat believes in 2024, we could see a 50 to 60% rally in IWM. This comes after the weakness you've seen so far to start 2024. This would imply Tesla would see potentially an even larger gain than that, because Tesla is higher quality and it does have interest rate sensitivity more so than even your small and mid cap stocks. Not to mention Tesla, like small and mid cap stocks, is very under allocated. Too few hedge funds and institutions actually own Tesla stock. It's majority owned by retail investors. So let's go ahead and kick off this video with about a 2-minute clip from Tom Lee.
I want to be optimistic today, and you do remain bullish. 5,200, correct?
Yes.
On the S&P is your price target for the year. That is not changing.
Yeah, I think investors who are long-term oriented should really just ignore the first 6 months. You know, we have a Fed that's going to be shifting from being really tight to accommodative. Earnings are recovering. We've got interest rates coming down. That's great news for consumers. And I think businesses in general have a CapEx cycle ahead. So, I mean, the stock market should do well this year. It's just, it doesn't mean it's a straight up.
Well, that's about a 9% gain from where we are now. If you are also correct in that the market tumbles a little bit in the next couple of months, you know, we all know it takes a bigger gain to get back to where you were after a drop because of something called math. So it's going to take maybe a 15% jump from the trough to get to that 5,200.
Yes, Brian, that's right. I think there's a chance at some point this year, maybe it's June, you have a chance to make 20% between now and year end. And I think small caps could make a bigger move, you know, 50 or 60%. So I think there's still...
What?
Yeah, I think the IWM could end the year, Russell 2000 could end above 3,000.
Now, I did not know you were going to say that. One of my 4 predictions, and no one cares what I think, but I do these predictions so people can tell me I'm wrong, and because they love to say you're wrong, right? Was that small caps would outperform the S&P 500. S&P 500 just seems 2.5 times sales, so far more expensive than any other major index around the world. It sounds like you would agree that people might start to find out there are a couple of other 1,000 stocks out there, which may deserve their attention.
That's right. And small caps relative to S&P on a price to book basis, back to where they were in 99. That was a launch point for 12 years of gain. So yeah, I'd agree with you. I think the calculus is favorable for small caps.
Repeat that. Small caps, price to book, 99?
Relative to the S&P 500 is back to where it was in 1999, which was the absolute low and was a launch point, 12 years of outperformance of small caps.
I do also believe that small and mid-cap stocks will outperform at some point in 2024. It's looking like we need clarity on where inflation is going to be, where the economy is going to be, how accommodative the Fed is going to be, whether or not we do get quantitative easing, 5, 6, 7 rate cuts, what the path ahead looks like. Once we have clarity on that, investors will position more into quote unquote riskier stocks like a Tesla, like your small and mid cap names. But here in the near term, I actually think we could see more downside on Tesla before things are all said and done, because it's unfortunate. Tesla's cut prices twice now already in 2024. They did not wait long. At the same time, the SPY has recently hit new all-time highs. And most likely, if we're looking at statistical probabilities, most likely stocks fall from here. Unless big tech S&P 500 EPS comes in with a projected growth rate of 11% or better, unless there's no hiccups with inflation rising, unless the economy continues to show we're avoiding a recession, then we will most likely see downside from here if all of those things do not continue to play out. Tesla stock is unfortunately starting at $215 per share. If we start to get bad earnings, start to get hiccups in inflation, and maybe inflation ticks up like it did in the UK last night. We went over that data in the video yesterday. Tesla stock already tends to fall more than the broader markets, so I am a little concerned about Tesla stock and where we could go next. I am a long-term investor, so ultimately it is a buying opportunity. And remember, as Warren Buffett has always said, you don't make money when you sell a stock, you make money when you buy a stock. So you want to acquire Tesla shares as cheap as possible, especially since you're watching this video and you already have a heads up that the end of 2024, second half of 2024, is probably going to be a lot better than the first half. We do have a little bit of good news for Tesla to share with you. It looks like institutions are buying more Tesla stock. This is as of December 31st, 2023. Vanguard purchased 3.45 million shares in the last quarter. BlackRock purchased 764,000 shares. State Street purchased 745,000 shares, and Geode purchased 2.22 million shares in the last quarter. You also did see JP Morgan increase their position in Tesla by about 2.68 million shares, and Morgan Stanley increased their position by about 2.18 million shares. Morgan Stanley and JP Morgan are actually pretty aggressively buying this dip in Tesla. You can see Morgan Stanley increase their ownership by 8%, almost 8% in the last quarter, and JP Morgan increased their ownership in Tesla over 10% in the last quarter. Goldman Sachs recently increased their position by 1.81 million shares of Tesla, adding about 13% more exposure. The selling that we did see last quarter from big banks and large investors is nominal. None of them selling over 1 million shares. Besides T. Rowe Price, they did sell about 1.39 million shares. That was only a reduction of about 5% though. So it does look like there is a decent amount of buying activity taking place from hedge funds and institutions in Tesla stock, probably for the same reasons that we are going over in this video. If we do get some weakness here in the first half of 2024, which we've already seen in the first 17 days of 2024, that's most likely a buying opportunity, even in the midterm, short midterm, just for the back half of 2024. The lower Tesla stock falls in the near term, the higher the likelihood is that you will make money towards the end of this year. Citibank says today, in response to the soft U.S. inflation data and Chairman Powell's dovish rhetoric, we now expect the Fed's first cut to occur in June, 1 month sooner than before, and we see 125 basis points of easing this year versus 100 basis points previously. So that equates to about 5 rate cuts. Markets are still pricing in just barely the first rate cut March 20th of 2024. You're pricing 51.9% chance of a rate cut in March and a 47% chance of a continued pause. For full year 2024, you are now pricing in 6 rate cuts with 36.6% odds and 5 rate cuts at 29.7% odds. So we're still double what the Fed said, but odds are we're going to meet somewhere in the middle. 4-5 rate cuts sounds appropriate in 2024. That does set us up with a risk, as I said previously, in the near term, coming January 31st, we may get an little more aggressively hawkish Fed Jerome Powell. He's probably going to say something along the lines of, we're not thinking about cutting rates just yet, and I could see how that could turn into a correction-like event for our markets. I don't think that is exactly accurate, and we would be in a world of trouble in our markets if that happened. I don't think that's going to happen, but are we going to see a rise in unemployment? Probably. Good news is Truflation's real-time U.S. inflation gauge has moved down to 2.1% from 6.4% 1 year ago. JP Morgan says we are inclined to view the January Empire reading as indicative of near-term weakness rather than a sustained slowdown in activity. This report is the first of several regional Fed surveys and will look to those and next week's flash PMI for more insight. This is in reference to the Empire State Manufacturing Index, which came out yesterday at -43, the lowest reading we have ever seen besides the Rona. The Atlanta Fed also says that firms' year-ahead inflation expectations significantly decreased to 2.2% on average. Bar chart on X reports that the 10-year Treasury is seeing its largest short position in history. Hedge funds are now short more than 787,000 contracts on the 10-year Treasury, the largest 10-year Treasury short position in history. Financial Juice on X, if you guys don't have a newswire or a terminal, definitely give this account a follow. They share news almost faster than it comes out on the terminal itself. He says that a 5 million option play targets U.S. 10-year Treasury yields at 4.5%, that this is bearish and it's coming from a U.S. trader. Now, explaining treasuries sounds more complicated than it actually is. The higher treasuries are, the higher this chart is. I'm looking at TLT, the ETF for the 20-year treasuries. Well, the lower the rate is. So higher the chart, lower the rate. Lower the chart, higher the rate. It works like a dividend stock. If you bought a $100 dividend stock that pays you $5 a year, that is a 5% yielding dividend stock. Well, let's say everyone wants to own that company because maybe the dividend's growing, maybe the business is doing well. Let's say that $100 stock now trades for $200 per share, and you still have the $5 dividend, no change there. Now you get paid 2.5%. So if you have the largest short on treasuries in the history of treasuries, that means people are expecting TLT to fall and 10-year treasury yields to rise. That is precisely what we have been seeing ever since you hit the low of 3.78% on December 27th. As of the time of recording this video, 10-year treasuries are up about 4 basis points today, now sitting at 4.10%. And let me just tell you, if 10-year treasury yields go back to 4.5%, stocks are going to be in a world of hurt. And let's be honest, stocks under the surface, taking out Magnificent 7, they're already in a world of hurt. The percentage of stocks above their 50-day moving average today alone dropped over 12%. Now, about 55% of stocks are above their 50-day moving average. So you're almost seeing less than half of stocks above their 50-day moving average. UBS cuts their Tesla price target to $229 per share from $250 per share, and they maintain a neutral rating. Option activity today in Tesla stock was definitely on the elevated side. The dollar amount was elevated and the amount of bears was elevated also. This is due to Tesla cutting prices of the Model Y in Europe and fears that we will see price cuts here in Tesla's most important market as well, which is the US. Here on the day today, you have seen 862 hedge fund institutional option trades totaling $5.66 billion with a positive order value of 31%. Even for retail trading activity, the total volume today was 37.35% to the call side and 62.65% to the put side. You can also see Tesla cost to borrow fees, the fee you pay to take out shares from another brokerage or firm to short them, right, is at 9.87%, which is very high for a large cap stock like Tesla. So there's a lot of demand for shares of Tesla stock to sell short. Tesla is now officially accepting questions for the Tesla Q4 earnings call. The earnings call will be held next Wednesday. And the selling keeps getting worse in Chinese stocks. Over the last 10 years, US tech stocks have returned about 509%. Chinese tech stocks have returned negative 11%. This is also something that is probably secretly weighing on Tesla as well, because you are seeing China in a pretty weak position. Jamie Dimon praises Trump and warns MAGA criticism could hurt Biden. Over the next couple of months, really the rest of 2024 is going to get very political. I just want to remind you, it does not matter who wins the big house, if you will. Stocks are going to do what they're going to do regardless. Stocks are not going to do better or worse depending on who wins. Jamie Dimon also had some pretty ominous things to say about the economy today alongside Goldman Sachs CEO David Solomon. Jamie Dimon warns all these very powerful forces will impact the U.S. economy in 2024 and 2025. Jamie Dimon says Ukraine, the terrorist activity in Israel, and the Red Sea, quantitative tightening, which I still question if we understand exactly how that works, Dimon said. Quantitative tightening refers to moves by the Federal Reserve to reduce its balance sheet and rein in previous efforts, including bond purchasing program. I actually talked about this yesterday in the video headline 60 to 90 billion stimulus coming every month, because the Fed is about to stop quantitative tightening. They're going to turn into a more accommodative stance, quantitative easing potentially, because banks are running out of excess capital to buy the bonds that the Fed is rolling off their balance sheet. So that will be a boost to our markets, which I expect will firmly have a grasp on valuations in the second half of 2024, meaning that stocks are not getting a boost on this today, but over the next couple of months, stocks will start to get a boost based on this stimulus that will be put out into the marketplace. Jamie Dimon says, quote, "I think it's a mistake to assume that everything's hunky-dory," Dimon said. "When the stock markets are up, it's kind of like this little drug. We feel like it's just great. But remember, we've had so much fiscal monetary stimulation, so I'm a little more on the cautious side." Goldman Sachs CEO David Solomon says Wednesday, while the market environment excluding geopolitical issues feels better today than a year ago, he was troubled by soaring U.S. debt levels. He says, quote, "I'm very concerned about the growing debt," Solomon said. "It's a big risk issue that we're going to have to deal with and reckon with. It just might not happen in the next 6 months." Now, the debt situation becomes a lot less of a problem when the Fed starts to actually cut rates. The interest expense on the debt is not going to be as bad. For an example, currently, we're spending more on just the interest payments on our $34 trillion in debt than we spend on the military every year. So it's about $840 billion or so dollars. That will fall as rates fall as well. So I actually don't think the debt is going to have anything to do with how stocks perform in 2024, but it can have an overall impact in, the next couple of years, how valuations are for our markets. Now, for anyone confused, why I bring this up is because it does have an effect on Tesla. Unfortunately, the markets or specific stocks don't live in their own market. So these things happening, for good or for worse, will have an impact on Tesla. And I'm not so optimistic about the generalized markets right now, even if I am optimistic about Tesla and how numbers will come in and how Tesla stock will perform in the second half of the year. Here in the short term, I do expect Tesla's probably going to break under $200 per share. You're probably going to fall back to about 190. Then you'll find a lot of support, likely around 195 or 190. If you fall under that, 180 and then 175 are your major levels to watch. Assuming that is, we don't get any more price cuts, then that would be the range I would target, between really about 185 and 200 as being the low. If we get more price cuts in the US, and the markets go through some kind of correction-like event, then you're talking about sub 170, 160, or potentially even 150. But if we get down to those prices, the markets themselves are going to be in a pretty rough place. In which, let's be honest, it's an election year. The last thing you want if you are trying to get reelected, in which the current president is a stock market crash. So by the time stocks are crashing, the Fed is going to be U-turning, printing money faster than you can even blink or watch this video, and stocks are probably going to come out of it pretty quickly. Coming out tomorrow, we will have some data as well. Fed Bostic will speak at 7:30 in the morning, and then you will get building permits preliminary numbers for December. This is highlighted in red, expected to be a major volatility catalyst. I don't think so, but the more permits, the better, the more supply of houses we could get coming on the markets, and that would be great news. Now, housing starts are expected to fall by about 140,000 down to 1.42 million for December, and then housing starts month over month expected to be down about 8.3%, negative 8.3%. Last month was positive 14.8%. Initial jobless claims. This is the leading indicator to unemployment. If you are going to see a spike in unemployment, typically you do see a spike in initial jobless claims first. Expecting around 207,000 initial jobless claims, but if this does spike, let's say 240, 250,000, potentially more than that, then you could, well, have a bigger problem on your hands. We also want to watch the Philadelphia Fed Manufacturing Index. Considering the New York Empire State Manufacturing Index just plummeted, does the Philadelphia Fed Manufacturing Index also plummet tomorrow? That could cause more fear for our markets. Then you're going to get Philadelphia Fed prices paid, new orders, employment, capex, and business conditions. All of that will be important as well. And then the ECB President Lagarde will be speaking at 10:15 in the morning tomorrow. That's like the equivalent of Fed Jerome Powell over in Europe. You will get Fed Bostic again at 11:30 and then again at 12:05. You do have a 10-year TIPS auction. This is 10-year treasuries, inflation protected. So basically like pricing and inflation for the next 10 years, essentially. Last yield we had was 2.18%. But if that comes in higher or lower, that can have impacts to our markets as well. And then tomorrow night, the Japanese inflation rate. Japan owns over $1 trillion worth of treasuries, which is by far larger than any other country. A lot of people think China owns the US. No, if you want to be precise, actually Japan owns the US. So depending how their inflation rate comes out, whether or not it looks like they will start cutting rates or raising rates, odds are they raise rates next. Well, that's going to be the first time in 16 years, and that could pull money out of our bond market and take it to the Japanese bond market, which would also have a pressure to send yields higher. Nonetheless, back to Tesla specifically on the charts, you're looking at the RSI at 30.70, so you are probably going to get a bounce at some point here. As I said in the video on Sunday, the price prediction video we go over every single Sunday, I think Tesla stock's probably going to close the week around 218, 219, maybe just at about 220. I do expect a bounce here. Now, that could be tomorrow, that could be on Friday. I'm not expecting a huge rally. I'm not expecting a continued crash also. But I do think if we look out over the next couple of weeks, there's a lot more potential risks that Tesla will fall compared to upside kind of catalyst or tailwinds for Tesla in terms of coming from the broader markets. In simplest terms possible, the markets are probably going to fall from here rather than continue to rally until we get clarity on inflation continuing to fall, which last inflation report was higher than expected, so that's not looking likely right now. Unless we hear brand new crazy information from the Fed, which looks unlikely from here, and unless earnings come in with better than 11% EPS growth, which looks unlikely in any normal year that's high, let alone a year with uncertainty like this, stocks are going to fall. So you're basically betting against probabilities here if you're overall bullish on the markets right now. Even Tom Lee, as we shared in the beginning of this video, says that you could see quite a pullback here. He does say, if you actually listen to the full video, it's like 8-9 minutes long. I didn't want to share the whole thing. He believes stocks could fall about 7% further from here over the next couple of months. That's kind of what I'm expecting as well. Not a full-on 20% crash-like event, but some form of correction at the bare minimum. But again, just to be very clear, any further dip from here is a massive buying opportunity. Personally, I think it's a buying opportunity right now, but the closer we get to 200, the better the buying opportunity is. Anything sub 200 is like, take my money, just take it all. I want as many shares as possible. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. My name is Michael Tyler. If you guys want to come trade with us live in real time, check out that link down below in the description of this video. It looks like those puts we had on Discover should pay out pretty nicely here, especially if the earnings call continues to drop the stock. Something else that could potentially move the markets here in after hours today if they say anything troubling about the consumer. Check out that link down below in the description of this video. Thank you for watching. Enjoy the rest of your day and night, and I will see you in the next one.